Titagar talking about the recent fundraising and order wins. In the meantime, holding out quite well for the market. The one stock, though, which is in focus is Sammaan Capital, and RBI and SEBI have now approved the ownership changes in Sammaan Capital. In fact, Harsh once again got in touch with Gagan Banga, the MD and CEO, to know more about the growth roadmap for the company going forward. Quite a few interesting takeaways is what we did get from Gagan Banga, and let's listen into that.
As an investing company, and they invest globally across a variety of platforms, regulated and unregulated businesses, are more controlled players. Over the course of the last 6 months, working with regulators, they have received permission from the Reserve Bank and other regulatory bodies to have control over the company and to be promoters of Sammaan Capital. So in that context, whether they are at 41 or 63, that really does not in any way dilute their seriousness about the business. If anything, you will appreciate that they are in the region is in the midst of a war, and not only was the RBI approval, which came in good time, but the turnaround after that by IHC was exceptional to turn it around in 3 days in the midst of a war, and to actually to subscribe to the preferential shares. So I feel this is a very long-term sort of a bet that they've taken. They would like to see more and more capital go into the company. There is a statutory obligation of an open offer. It's really for the market to decide how it would like to play from here.
I mean, your words say it all. Thank you for that. Give us a sense, Gagan. How's asset quality behaving on ground at this point? You've done very well, at least from this financial year standpoint. Is that sustaining? Are you confident with regard to your NPA ratios? Give us a sense.
Credit quality overall is fairly benign at this point in time. I would imagine that we are in a fairly good credit cycle, as is evident from the performance of not only Sammaan but our peers as well. That said, there is a huge macroeconomic development which I don't believe anyone had really factored into their risk assessment models. So we are all working now to see whether such black swan events can ever be thought through in a ECL model. That is one thing that we are working on, and the other is that what I'd spoken about when we had announced the deal at October, that come the consummation of the transaction, we have to make sure that this whole legacy business, unwinding of the legacy book, etc., all of that is behind us. So I think we've used the last 6 months very, very effectively. Going forward in fiscal 27, I am not only confident but very, very optimistic about how the company will play out, especially after this large capital infusion.
Gagan also talked to us about your conversations with regard to how rating agencies are treating you as a result of this. Are you already in late stage of those conversations? Are rating agencies already making inquiries? Because if asset quality headwind is gone away and you have this large investor coming in the form of IHC, very likely you will get upgrades. And as a result of which, what might likely happen is your cost of funds may fall fairly quickly. So two-part question. One, what are rating agencies doing? Second, how quickly do cost of funds come down?
So ratings typically, when such an event is announced, are put under watch. Rating agencies anyways are very vigilant, and they are, for a highly rated company like ours, they are in extremely regular touch. So they know it all. We obviously have to now, post the consummation of the transaction, go back to them, explain the revised business model, explain how we are dealing with the legacy book, etc. And on that basis, they will take a call. The fact of the matter is, one, UAE has a AA credit rating versus India's BBB minus. B, IHC as a company is larger than the largest corporate in India. And having such a promoter coming from a country, those two will certainly have a positive rub off on the ratings. And as you rightly said, it should happen in quick time. My estimation is that over the course of the next 6 to 12 months, incremental flow of capital will be happening at something like 250 basis points lower to where we are borrowing right now.
Gagan, your current book size is around 65,000 crore, but the growth book, right, excluding traditional, is roughly between 45, 50,000 odd crore. Your goal to hit that 1 lakh crore AUM by end of FY27, how realistic is that?
It's not the growth and the legacy breakup that we are talking about. We have an AUM of 65,000 crores. Whatever we have to do to make sure that there is one consolidated AUM, which we will be tracking going forward, is being done. On that basis, if we have to look at AUM projection over the next 12 months, we will be calibrated. Over the next 2 years, which is fiscal 29, I am fairly confident we will have a run rate of 25 to 30,000 crores of disbursements, which should comfortably get us to a 1.3 to 1.5 lakh crore AUM by fiscal 29. Where we start, the year, unfortunately, we're getting to start from the first day of the year. I think we have a fairly good path of disbursals ahead of us. We should be disbursing something like 35,000 crores this year, which is fiscal 27.
Okay, and therefore you'll be shy of that 1 lakh crore AUM end of FY27?
I'm, like I said, I'm more focused on disbursals and dealing with the legacy such that when we announce our results, there is no mention of legacy. That's what I'm more focused on, not so focused on the lakh crore.
Excellent. Your margins, Gagan, you've spoken about cost of funds, you've thrown some color on it, but talk to us about how quickly do margins expand, because that's the one key piece which the street is looking for. Plus your product tilt. You're going to expand your product suite quite sharply. What does that do to your yields, margins? Give us some color on that.
So if one is to do nothing and just allow the rating upgrades to play out, and as a result, the cost of fund reduction to play out, our margins automatically on the static book automatically double. So if we have, let's say, a 250 basis points saving on incremental funding, on stock, we should be able to, over the next 12 months, reprice our stock by about 200 basis points at least, which will double my margin. So it's a very comfortable position here on in terms of profits. We will certainly see a bump up in operating expenses as we go towards a city coverage of 500 cities, increase our workforce and take it to a direction of 10,000 people by fiscal 27. And very importantly, make heavy investments in tech. As we do all of that, operating expenses go, but on a relative basis, profitability still doubles, because whatever the spread on the growth business is on the incremental businesses is going to take care of all the operating expenses, and the margins by just saving on cost of funds automatically double.